Hi, I'm Hilary Dudley, the Managing Director of Citadel Fiduciary, and I'm here to talk about the Draft Taxation Laws Amendment Act 2016, which is currently before Parliament. The Draft Taxation Laws Amendment Bill 2016 has been at least 3 years in the making, as it has its genesis in the 2013 budget speech where the Minister of Finance announced far-reaching changes to the way in which trusts are taxed. Subsequently, the Davis Tax Committee was mandated to investigate the taxation of trusts and estates, amongst other taxes in South Africa. And Judge Davis has released 2 reports on estate duty dealing with trust taxation. However, Section 7 Cap C, as set out in the Draft Taxation Laws Amendment Bill, is something which Judge Davis didn't recommend be implemented. Treasury is, however, intent on implementing the new law, and indications are that it will be effective from the 1st of March 2017. That doesn't give people who have made interest-free or low-interest loans to trusts a lot of time to consider their options should they deem it necessary to restructure their trust. Essentially, the Draft Taxation Laws Amendment Bill is intent on introducing a Section 7 Cap C to the Income Tax Act. And the effect of this section will be to deem an interest rate at the official rate of interest on any loan made from a person, a natural person, to a trust, or from a company to a trust at the instance of a person who's connected to the company. What this means is that if a client has made a low interest loan or a zero interest loan to a trust, they will be deemed to be earning 8% on that loan. In the first iteration of the bill, it was deemed that the 8% would be added to their taxable income and taxed at their marginal rate. And to the extent that the trust didn't refund the tax paid by the person within 3 years, the individual would be deemed to be donating that money to the trust. However, in the second version of the bill before Parliament, which is the one that would be approved, presumably, the deemed interest is treated as a donation to the trust by the individual. So in other words, you are meant to be charging interest and you don't, so you're deemed to be donating interest you could charge to the trust. What this means is that any person with a loan, an interest-free loan of more than 1,250,000 Rand will be liable to pay donations tax. Remember, there's a 100,000 Rand a year exemption from donations tax, and accordingly, interest earned on a loan of less than 1,250,000 is less than 100,000 and you don't pay tax. So what this means is that people with loans of more than 1,250,000 will be liable for additional tax from the 1st of March next year. It's important to note that Section 7 capital C, which is going to attribute an 8% interest rate to loans to trust, does not apply to every loan to a trust. And there are exemptions. For example, if you lend money to a public benefit organization, in other words, a charity, you're not liable for interest on that loan. For example, if you've lent money to a trust to enable the trust to acquire a property that you or your spouse are going to occupy, that loan will not attract interest. In other words, where you're going to live in the trust's house as your primary residence, the loan you made to the trust to acquire the house won't be subject to this interest. There's several options to consider when deciding how to deal with this. Firstly, you could do nothing and end up paying additional tax every year. Depending on the quantum of the loan, it might not be a lot of additional tax. However, a lot of people want to order their affairs to pay as little tax as possible, and so it's not palatable to them to pay donations tax. One of the options then is to repay the loan. So in other words, the trust repays the loan to the individual, and the individual sits now with the asset in their own hand, and there's no loan to the trust. Another option is for the trustees to give the individual, the lender, a vested right and income to the trust in order to repay the loan, which would prevent the application of Section 7 capital C. There are other options that are quite technical. For example, you could do a corporate rollover. There are ways to offset debit and credit loan accounts. Our advice is that individuals should seek bespoke guidance and advice in deciding how to deal with this, and not to make any decisions in a hurried manner or any rash decisions. For example, just to terminate the trust entirely, because this might not be appropriate. So it's important that you go and you seek guidance and advice from someone who's qualified to give you the answers that are best for you and your family.